Have you ever wondered where the money you deposit in your bank ends up and why they pay you interest for keeping it safe? Well, what if I told you that banks create artificial money on a daily basis? These intriguing topics are covered in today's Capital Clarity episode. To begin with, when you deposit cash at a bank, they offer an insignificant amount of interest. Afterward, the money is lent to individuals and businesses at a significantly elevated interest rate by these banks. The disparity between the loan's interest fee they impose on their customers and what they provide you as an account holder makes up for the bank's earnings. For this reason, deposits are offered with benefits of yielding interests in exchange because it enables banks to make profits from them. Banks aim to increase their lending and profits by acquiring more deposits, which serve as the foundation for loans. However, one might question whether banks are fulfilling their responsibility of safeguarding customers' funds in order to allow them access at a later time. In reality, fractional reserve banking permits banks to retain only about 10% of deposited money while loaning out the remaining amount. The Federal Reserve establishes this sum, which serves as a safeguard for when clients seek to withdraw money from their accounts. And lo and behold, here's the trick that generates revenue if you were to deposit $10,000 into your savings account. When the reserve requirement is 10%, banks are obligated to hold on to $1,000 and can lend out up to $9,000. With this in mind, suppose you have a balance of $10,000 while another customer has access to cash worth for that amount. Your deposit suddenly acquires an increased value of $19,000 total. Subsequently, when said client completes their own transaction with their bank account by adding a payment sum worth accordingly precisely a similar manner. The same stipulation applies whereby only 10% will be held back as reserves, whilst 9/10 becomes accessible for loaning onwards once more. This chain reaction continues indefinitely into successive individuals' transactions within banking institutions at large. Can you visualize the direction this is heading? Essentially, banks ramp up the money supply, i.e., overall amount of currency in circulation minus any increase to tangible cash flow. Whoa there, let's pause for a moment. Previously, it was mentioned that loans are generated by deposits. The reason banks strive to acquire more funds through deposits is because they serve as the basis for creating loans. However, in a particular instance where our bank extended $9,000 to one of its clients and subsequently received a cash deposit from them equivalent to said amount, created an additional deposit of $9,000. Wouldn't it be more accurate to assert that deposits are created by loans? Although one might assume that the fractional reserve requirement restricts a bank's lending capacity, these regulations have minimal impact on limiting banks from providing loans. In reality, many major banks tend to issue new loans before addressing any compliance with reserve requirements through acquiring fresh deposits or borrowing funds from other financial institutions at low interest rates. So what exactly restrains bankers from exploiting this method of perpetually creating additional loan accounts and increasing profits? Firstly, profitability serves as the primary limitation. When granting loans, banks have more than just the interest rate to bear in mind. They need to factor in overhead expenses and potential financial losses if a borrower defaults on their repayments. In addition, capital requirements also impose significant restrictions on bank lending practices. To put it in layman's terms, capital requirements refer to the level of funds that a bank is obligated to maintain against its overall lending. Essentially, this means that banks are required to retain some portion of their profits instead of distributing them among shareholders. As such limits tend to act as a fail-safe mechanism for most banks, you don't have much cause for concern about losing your deposits held with any local bank. Nowadays, the majority of banks are protected by the Federal Deposit Insurance Corporation, FDIC, a government entity that guarantees up to $250,000 of your deposits in order to keep your funds secure. Thank you for tuning in. Don't forget to drop a comment on what topic you'd like us to cover next, and if this is your first time here, hit subscribe for more finance-related content. From 1947 to 1991, the United States and Soviet Union were in a state of heightened political and military hostility known as the Cold War. Both nations engaged in covert operations, propaganda efforts, and proxy battles throughout various regions globally, with each vying for dominance over one another. The significance of this era cannot be exaggerated as it greatly impacted global stability. For decades, international relations were molded by the Cold War, which defined the geopolitical landscape and impacted domestic policies in both nations. The intense competition for military superiority culminated in extensive spending on weaponry from either side, while differences in beliefs led to battles such as those experienced during Korea and Vietnam Wars. In 1991, it was only after Soviet Union's disintegration that this era of conflict ceased to exist. Tensions linger between countries even today, however. Invaluable lessons learned over time stress diplomacy accompanied with peaceful resolution when handling disputes. Don't forget to subscribe and watch more at Capital Clarity.